Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath. We really do appreciate the support. It keeps the show going.
Absolutely.
So let's look at the calendar. It is Friday, January 30th, 2026. And the markets have been, well, let's just call it energetic lately.
A word for it.
But there's one name that just keeps dominating the headlines, the chat rooms, and, frankly, my own watch list, Palantir. It feels like every time I turn around, someone is talking about them. Why now? Why is this the company everyone's focused on?
It's because we've officially entered what some analysts are calling the AI decisioning supercycle.
Okay.
And Palantir has, well, they've managed to position themselves right in the eye of that storm. You have to remember, for years, the whole story on this company was that they were this mysterious niche government contractor.
Just a spy software company, right?
Yeah, exactly. That's what everyone thought. But what we are seeing right now in early 2026 is a fundamental shift. They've gone from being a government specialist to a commercial juggernaut.
A commercial juggernaut. That's a pretty heavy word. It implies, unstoppable force, massive size.
It's really the only word that fits the numbers we're seeing. They aren't just analyzing data anymore. They're becoming the operating system for decision-making in both the Pentagon and, the Fortune 500.
Okay, let's unpack that, because juggernaut is a claim, and we need to back it up with reality. You've got the data on their recent performance. How fast are we actually talking here?
Incredibly fast. So let's look at the financials that dropped recently. We're looking back at Q3 2025 revenue. It hit $1.18 billion.
Whoa, just to clarify, that's $1.18 billion in a single quarter.
In a single quarter. And that blew past the estimates, which were sitting around $1.09 billion.
Okay.
But the raw number isn't even the headline here, as impressive as it is. It's the velocity. That represents a massive 62.8% year-over-year growth.
62.8%. That's significant. I mean, usually when software companies get to that billion-dollar revenue mark, the law of large numbers kicks in.
Right. It gets harder to double.
Yeah, it gets harder to grow that fast. You see growth slow down to 20, maybe 25% if they're lucky.
Exactly. That's the standard playbook for a mature tech firm. But Palantir is, defying gravity here. They're accelerating. This was their 9th consecutive quarter of acceleration. Ninth. And the expectations for fiscal 2026 are getting even wilder. Citi just came out with a forecast. They revised their estimates up to 70 to 80% total revenue growth for this year.
Wait, 80% growth? For a company already making billions? That's almost unheard of in enterprise software. I mean, that sounds more like a startup number from a company making its first 10 million.
It does. And it naturally begs the question, all right, where's all that money coming from?
That was literally going to be my next question. Because historically, the knock on Palantir was always, okay, they have Uncle Sam's credit card, but can they sell to regular businesses? Is this still just spies and defense contracts driving the whole thing?
And that's the misconception that just won't die, but the numbers absolutely destroy it. Here's the stat from the Q3 report that really stands out. U.S. commercial revenue surged 121%.
A 121% jump in commercial. So we're talking banks, hospitals, manufacturers.
Exactly. Energy companies, airlines, logistics firms, the whole sector. The commercial business is exploding because these companies realize that, just having a chatbot isn't enough.
Right.
They need AI that actually helps them run the business. So, yes, the government side is still huge. The Q4 consensus for government revenue is over $707 million, growing at roughly 55%. But the commercial side is catching up so fast.
So it's a dual-engine jet. You've got government growing at 55%, which is amazing on its own, and commercial is basically doubling.
Precisely. It's a dual threat model. And that diversification is what has investors so excited. They aren't reliant on a single budget or, a single administration anymore. If one side slows, the other can pick up the slack. But right now, both engines are just firing on all cylinders.
Okay, so the top line is beautiful. The revenue is pouring in. But I have to ask the question that usually spoils the party for these high-growth tech stocks.
Bottom line.
The bottom line. I mean, when you see 80% growth, you usually see a company burning cash like it's going out of style. Are they spending $2 to make one?
And this is where it gets really interesting and, frankly, where Palantir just separates itself from the rest of the sauce pack. They are arguably best in software when it comes to profitability.
Best in software. That's a bold claim. I mean, you've got companies like Microsoft out there.
The margins back it up. In Q3, their gross margin was at 82.0%.
So for every dollar they bring in, 82 cents is profit before you even pay for operations.
Correct. And the net margin, The money they actually keep at the end of the day after paying for everything was 28.1%.
28% net margin. That is incredibly healthy. That sounds more like a mature monopoly, not a high-growth disruptor.
It reflects just pure operational efficiency. They aren't just selling software, they are scaling it cheaply. They've built the platforms, Foundry, Gotham, AIP, and now they are just deploying them.
So the heavy lifting is done.
The heavy R&D lift is paying off. And they don't have a significant debt load dragging them down either.
So they are effectively printing cash?
They're a cash fortress.
Yeah.
Free cash flow is projected to approach nearly $5.9 billion by 2030.
Nearly $6 billion in free cash flow.
Yeah.
That is a lot of dry powder, which makes me wonder about capital allocation. With that kind of cash, are we talking dividends, buybacks?
Not anytime soon. And honestly, you shouldn't want them to. They are prioritizing reinvestment right back into growth. Specifically, they're funding something called modular sales expansion.
Modular sales expansion. Translate that for me.
Think of it like Legos. Before, if you wanted Palantir, you had to buy the whole castle. It was expensive, heavy, took a long time to install.
Right.
Now, they're breaking their platform apart. You can buy just the supply chain block or just the HR analysis block. They're finding ways to sell parts of their platform to smaller clients to scale them up.
The classic land and expand strategy.
Exactly. They want to capture the entire market, not just the top 1%. So no dividends. They are pouring all that fuel right back into the engine.
Which makes sense. If you can grow at 80%, why would you give the cash back? You reinvest.
You reinvest, exactly.
Okay, I want to pivot to the why. We see the revenue, we see the margins, but why a Palantir? I mean, why can't Microsoft or Google or some startup just copy what they do? What is the moat?
This is the most critical part of the whole thesis.
Yeah.
It all comes down to what they call the ontology.
The ontology. That sounds like a philosophy class.
It does, but in tech terms, it's like the data structure of the real world. Most AI, like the chatbots everyone plays with, it just deals with language.
Right, text.
Palantir's AI deals with objects and actions. It maps a company's entire reality, its factories, its supply chains, its employees, into a digital twin. It harmonizes all that data.
So it's not just reading a PDF. It understands the physical reality of the business.
Right. So let's say you're a manufacturer. A chatbot can read a report and say, production is down. Palantir's ontology understands that because a specific machine in Ohio is broken, it will affect the shipping schedule in London 3 days from now. It connects the dots.
It'll ask for decision-making, not just, information retrieval.
Precisely. And their whole product, Suite AIP, Foundry, Gotham, Apollo, it's all fully integrated. Once a government or a massive company integrates their entire data universe into this ontology, switching is incredibly difficult.
The switching costs must be astronomical. You can't just unplug your brain and plug in a new one over a weekend.
You can't. It's so sticky. And in the government sector, that moat is even wider. Palantir is one of only 5 SaaS providers authorized for mission-critical national security systems by the Department of Defense.
Only 5?
Only 5. That authorization is a massive barrier to entry. A competitor like, say, Big Bear or C3, they can't just walk in and pitch the Pentagon for level 6 data access. It takes years of vetting. Palantir is already there. They are entrenched.
So they have the commercial growth, and they have what's basically a government monopoly protected by security clearance. That explains the moat. Okay, so how is the market reacting to all this? We're recording this on January 30th, 2026. What's the chart look like?
It's what you'd call a psychological uptrend. If you look back over the last 3 years, the stock has seen triple-digit returns. Right now, we are trading in the $165 to $179 range.
$179. I remember when this was a $20 stock. Feels like yesterday.
It's been a wild ride. But the analysts think there's more room to run. Citadel has a buy rating on it with a $235 price target. And other projections see it breaking $200 pretty comfortably by the end of this year.
So even after this huge run-up, Citi sees another, 30–40% upside?
They do. And the sentiment is backing it up. We look at quantitative sentiment scoring, which analyzes news and social media chatter. Palantir is scoring a 9 out of 10 bullish.
People love a winner.
They do. And the partnerships validate it. They just signed a deal with Innodata.
Innodata. I haven't heard much about them.
It's a key partnership for AI data engineering and video annotation. It sounds technical, but it's crucial for training their models on video data think drone footage or factory cameras. It validates that the ecosystem is growing beyond just, spreadsheets.
And what about the big money, the institutions? Are they piling in?
We haven't seen specific cluster buying from insiders recently. No CEOs buying massive blocks last week or anything. But the institutional accumulation is kind of implied. When you have that much government reliance, that level of security clearance, the big pension funds and asset managers feel safe holding it. It's become a staple.
Okay. I have to play the skeptic now, because my job is to protect the listener's wallet, not just hype a stock. This all sounds a little too perfect.
There's always a catch.
The valuation. We're talking about a stock trading at what?
It's trading at roughly 102 times sales.
102 times sales, not earnings. Sales.
And the PE ratio, the price to earnings, is roughly 422x.
422 times earnings. I mean, that is nosebleed territory. That is oxygen mask territory. Usually anything over 30 or 40 is considered expensive. 422 implies the market expects, like, perfection for the next decade.
It's expensive. There is no way around it. That is the number one risk. The skeptics, the value investors, they argue the fair value is closer to $60. They look at that PE and say, this is a bubble.
And if the market turns or if growth slows, even a tiny bit, say it drops from 60% to 40%, a 400 PE stock can get cut in half overnight.
That is the danger. But the rebuttal, and this is what the bulls are betting on, is that you are paying a premium for certainty and for growth. If they actually hit that 70 to 80% growth target for 2026, that PE ratio comes down very fast.
Because the earnings, explodes.
Exactly. The earnings explode.
Oh.
You are paying up for the clear leader in what looks like a winner-take-most market.
So the argument is, yes, it's expensive, but it's the only game in town growing this fast with these kinds of margins. It's the same argument people made about Tesla or Amazon for years.
It's the exact same argument. And you have competition, of course. We mentioned Big Bear. You have legacy players like Intel or Lumen trying to make noise. But the argument is that Palantir's moat, that ontology, makes them distinct enough to justify the price.
It's not a car company, it's a tech company. Palantir isn't a consulting firm, it's an OS.
Right. And the market is currently buying that story.
Okay, so if I'm an investor looking at this today, January 30th, what am I watching for? What are the catalysts in the next, say, 3 months?
Well, the big one is imminent. We have the Q4 2025 earnings coming up just after this weekend.
So basically any day now.
Yes. The consensus expects 61 to 62% revenue growth. If they beat that, if they come in at 65% or higher, it could trigger another big rally.
And if they miss?
If they miss, with a 400 PE, it will be ugly. But the macro tailwinds are strong. U.S. defense spending is rising because of geopolitical tensions, and the demand for AI data centers is, insatiable. Both of those really favor Palantir's dual threat model.
And looking further out, the long view.
The long view is this speculative catalyst. It's the idea that this AI supercycle causes their customer base to just explode through those modular sales we talked about. If they can sell to the mid-market effectively, their total addressable market becomes, well, virtually infinite. Price targets for 2030 are suggesting a climb toward $288.
$288, so a potential double from here over the next 4 years if they execute perfectly.
If they execute, that's always the big if.
All right, we've covered the fundamental explosion, the fortress balance sheet, the ontology moat, the sky-high valuation, and the upcoming catalysts. It's time for the verdict. Sum it all up for us.
I'm giving Palantir a bullish score of 9 out of 10.
A 9. That is high.
It is. Here's the elevator pitch. You have a company with exceptional margins, 82% gross. They're tripling their commercial sales in the U.S. They have absolute dominance in the government sector. And they are profitable. Yes, the valuation is scary, but this is a buy high, sell higher situation. The momentum is just undeniable. I think it's a buy now, ahead of earnings for multi-year compounding.
Multi-year compounding. The magic phrase.
It is.
Well, there you have it, a 9 out of 10. But I have to leave you, the listener, with the final question to think about this weekend. We know the tech is good. We know the growth is real. But does a 422x PE ratio scare you to death? Or is that just the price of admission for the next tech giant? Is the growth worth the price?
That's the question that makes a market.
It certainly is. Thank you all for joining us on Smart Wealth with Joshua. We'll be watching those earnings very closely.
See you in the next one.